I'm Michael Landman. I've been part of the IFM Investors Global Infrastructure Investment Team for 15 years. I spent my earlier career dealing with risk, but in the unusual context of researching turbulence in pipes and trying to strike oil in the tropics from offshore rigs. I've come to the view that infrastructure investment is equally interesting, though fortunately much more stable and more predictable than my former pursuits. It's a diverse and fascinating asset class, provided quality assets are bought well and managed well. Inflation has accelerated globally as a result of the disruption experienced as the people and economies emerge from the shadow of COVID, and they deal with the impacts from the current upheaval in Ukraine. Inflationary pressures from supply-side constraints are proving to be far more persistent than previously thought. In response, interest rate expectations have shifted, and the US Fed and other central banks are in the midst of what looks like to be a relatively aggressive program of rate hikes. Higher interest rates have traditionally been viewed as a negative for the performance of long-duration investments like infrastructure, as they put downward pressure on asset valuations. This is directly due to the potential increase in the cost of borrowed capital, and indirectly because the discount rate used to value cash flows is likely to increase in response to changes in the risk-free rate. It's worth pointing out that, like asset managers, independent valuation firms who value infrastructure assets tend to look at the long term and set the risk-free rate having regard for historical long-term sovereign bond rates and sustainable changes in the sovereign bond rate. However, there are a number of interdependent factors that need to be considered. Infrastructure assets are often positively linked to inflation through contracted increases in prices for services that are linked to CPI, for example. This can be a feature of regulated utilities, toll roads, ports, and normally means that revenues continue to rise as inflation increases. Revenue is, of course, price times volume. So as economies grow and the use of essential services increases, this can have positive flow-on effects to revenues in the infrastructure asset class. So both inflation and economic growth can provide a natural hedge that may offset any adverse impacts from rising rates. We would need to be more vigilant if aggressive tightening of monetary policy pushes economic activity into recession territory. If this were accompanied by a rapid deceleration of inflation, we could see a period of reduced performance while a relatively elevated rates environment continued to persist. In these conditions, I think unlisted infrastructure would generally outperform other equities, however, and potentially most other asset classes. This is because infrastructure investments are generally in businesses which operate real assets that provide essential services, such as water and electricity utilities, ports and airports, where the demand is relatively inelastic and not subject to the level of competitive forces seen in other industries. The proviso, however, is that asset managers need to have appropriately conservative capital structures in place to help mitigate the direct effect of rising interest rates on the cost of their debt. It is worth noting that an alternative to investing in unlisted infrastructure is through the listed market. As an asset class, the performance of listed investments is normally more volatile and is subject to a broader market sentiment, whereas unlisted infrastructure is valued by professional independent valuers, usually quarterly under various well-recognised accounting and valuation standards. Nevertheless, let's consider unlisted investments in infrastructure. Despite the choppy market conditions we've seen in 2022, year-to-date to the end of August saw the S&P Global Listed Infrastructure Index up 2%, while the broader MSCI World Equities Index was down 17%. I believe this is a strong reflection that the broader market recognises the resilience of the infrastructure asset class, both listed and unlisted, in the current and expected inflationary macro environment. Similarly, a key unlisted infrastructure performance index, which is released quarterly, also saw positive performance over the first half of the year, in contrast to the global equity market, which had significantly corrected down by 20%. I think the most recent surprise has been how resilient the movement of freight has been both locally and globally. While COVID triggered supply chain disruptions and higher logistic and input costs, trade has generally held up well, and this has supported many transportation sector assets in our portfolio. Many of our toll roads, for example, have seen record heavy vehicle movements, noting that trucks pay higher tolls than cars, supporting the investment thesis. And this is because trucks have an increased footprint on the road, displacing cars, and also they have increased wear and tear on the road surface. Conversely, airports could not escape the very significant disruption to people movements from early 2020. But we have been surprised, as have the airlines, how rapidly the public has returned to short and long haul traffic this year, despite higher ticket prices. When IFM started investing in unlisted infrastructure more than 25 years ago, we were considered to be pioneers. Jump to today and we are seeing global recognition that private market investment, particularly in infrastructure, is a key asset class in a long-term portfolio such as those held by pension funds. And this is for good reason. These are investments in real assets that are in the right circumstances can generate quality earnings from providing essential services that communities rely upon every day. This underpins a relatively stable performance base and also provides us opportunities for organic growth through relatively low risk capital projects that meet growing demand and increased efficiency. Furthermore, as an asset class, unlisted infrastructure has a low correlation to broader listed markets, bringing portfolio construction benefits to investors. And of course, investors are looking for the hedge to inflation. Most institutional investors will require a specialist manager to access these types of investments. Obviously, the quality and diversity of the portfolio of infrastructure assets being accessed is an important consideration. IFM Investors specialises in open-ended investment vehicles, which provide new institutional investors with the benefit of accessing a mature portfolio of assets when they are drawn into our portfolios. These portfolios are diversified not only by sector and geography, but also by what we call revenue characteristics. Institutional investors also benefit from our use of a proprietary portfolio construction framework called InFrame, based upon underlying revenue characteristics. This methodology provides our investment team and decision makers guidance on the balance of risk and return for our core infrastructure portfolios. So InFrame provides a more granular and nuanced approach than only looking at the mix of sectors and geographies in an infrastructure portfolio. In closing, I believe that the performance of a well-managed infrastructure portfolio will continue to benefit from the key positive investment characteristics of this asset class. Key amongst these is protection from inflation, which I think will be a critical factor supporting the robust performance for investors in the current uncertain economic environment.